Okay, guys, you should be able to see my desktop now. You should be able to see our disclosure. If FX Street admin could just confirm, and then we can get going. Okay, everything's fine. That's great. Just to go through our disclosures, guys, this presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation or webinar has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient. We don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products may involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, are not available for all US residents due to regulatory reasons. Okay, guys, let's get to the interesting stuff. Just a little caveat before I start. I'm going to be using Bloomberg charts all throughout this whole webinar because I have my other in-house system is I've just got a slight problem with it at the moment, and it will be hopefully back up and running shortly. So all the charts I use will be these ones with the black background. I know some of you will know Bloomberg already, but some of you won't. So these are Bloomberg charts. I know some of you ask often where I get my charts from. So these are prices offered by Bloomberg, not by Forex.com, just to remind you as well. Okay, well, this is funnily enough, BP's share price, which has been slightly lower on the day, but overall has been recovering. And this was just over something else that I'm looking at. They released some reserve data later today, which will be worth watching if any of you are interested. But let's get back to our FX side of things. We're going to look at Euro first because Euro's been a bit of a mover to the downside. There's been a few negative developments in the Euro area, really. Well, the first thing is there's some now real fears growing. Oh, sorry, guys. Let me just bring that up properly. Some real fears now of starting to form about Germany and its GDP. It releases its GDP estimate at 7 a.m. London time on Thursday. Concerns are that it's going to be very, very weak. Let me just get you the exact market expectations. Oh, there we go. The market is expecting a fall of 0.1% anyway on the quarter, and for the annual rate to fall back to 1.4% from 2.3%. There is a real risk that it could be lower now. We did have a very dismal ZEW survey. For those of you who know the German data, I know some of you may not, so I'll just quickly go through it. The German ZEW survey is really important. Firstly, it's one of the first indicators we get for August. From Germany, and obviously Germany is a proxy for the Eurozone as it's the Eurozone's largest economy. The other thing of why it's important is that it has two components. So it looks at the current situation and the expectations. Now the expectations part tends to be more important for the markets, basically. For obvious reasons, markets like to price things in ahead of time. That fell to its lowest level since December 2012. Hence why we've seen the euro really decline here. As you can see to the right-hand side of this chart, very long blue candle to the downside. That indicates a down day. Now, obviously, we're only partway through the day, so there is time for a recovery, of course. Right now, sentiment, without any other economic data coming out later today, with no central bank speakers, seems to be decidedly bearish for the euro. Yes, and it has been bearish for the euro for quite some time. I mean, look, we're at the lowest level since November. 133.33 is our next key level of support. Now, why I point that out? I point that out because it is the lowest level from August 6th. Below there, we're getting to the November low, which comes in at 132.96. And then we're really starting to look at 132.48. And that's significant for this reason. Let me just draw it in for you. Let me just do the retracement. Sorry, it's a retracement when it gets to this level. So it's from the July low all the way up to the May high. The 132.50 level, as you can see here, 132.48.50 is the 38.2% retracement of that entire move. Now, obviously, this has been a 2-year uptrend. When you look at Fibonacci's, guys, there are a couple A couple of things to point out. The first thing, obviously, they're very, very good, especially when you're looking at kind of, is this going to be the end of a potential uptrend, particularly on these type of time frames. The market, a lot of people are looking at them. A lot of people are looking at that 132.5 level. And I would add that, some people say to me, well, what's the most important Fibonacci level? Well, 38.2% is obviously, 38.2, 50, and 61.8. When you get to the 38.2, if you hold support there, that suggests it could just be maybe a deeper pullback than some expected. But we could potentially, bounce from there. As I said, a lot of people in the market know it. It tends to focus minds as a key support level. Below there, obviously, the 50% retracement. Once you get to that level, I think a lot of people are really thinking on the downside. And then, of course, a break of 61.8% suggests that, there's a lot of momentum to the downside. I mean, that's where we could be going. Now, some people, obviously, I was reading something by UBS actually yesterday, and they kind of think that actually losses in euro dollar could be maybe a bit overdone, that euro dollar could maybe recover from here, but so far the technical signals aren't looking that way at all. I think there is further downside of it. There could be further downside, and I think that whether or not we extend that loss will very much depend on how we act around 132.50. But I wouldn't be surprised if we do see back down to there. Now, Alan, I know as usual we've got tons of questions, which is always good. We will look at Aussie in one moment, and obviously CAD. I know that you like those commodity currencies. And that plays in quite nicely to that theme, which I think some people are looking at now, that potentially euro, potentially the euro could be, if the euro is going to recover against the dollar is still going to, strengthen. Maybe the strength in the dollar, especially if the Fed doesn't tightens policy at a glacial pace. The strengthened dollar could be a bit selective, and it could be, more likely against your Aussies, your CADs, your Kiwis, than it is, say, against the euro and the pound. It's a big week for the pound. Obviously, tomorrow, massive day. We get employment report and the latest inflation report. Remember, there's only 4 of them a year. This is the third one. It will be the third time that we get a press conference from Mark Carney. Now, this can have massive repercussions for the pound and for other assets. This is cable, as you can see. Cable also been as weak, not as weak as the euro, but it certainly has been falling. 167, as you can see, just look here. If you look at the right-hand side, let me zoom in a little bit. Tiny little candles over the last 2 days, or yesterday and today, basically. And that's because we are leading up to this major event on Wednesday. And whenever you lead up to these major events, you do tend to see the market just back off just a little bit. So hence we've been in this really tiny little range. In terms of where we could go next, 167.40 is a key level of support. That's because it's a 62% retracement of the March to July advance. So let me just reset this, and I will draw that in for you. Oh, no, sorry. Wrong annotation scale, wrong annotation tool. So where are we? March low to the July high. Again, with retracements, it's good to have a good, few months to look at. So yeah, as you can see, 167.40, that's 61.8% retracement of that entire move. That's a significant move. And one thing we have seen is that back at those days when we were at 170, we were looking very stretched to the upside. But now actually data is suggesting that people have cut a lot of longs. Now, I know for some of you who are new to this, that may be kind of a difficult concept. Why does it matter? Surely that means, if something's stretched that everyone's, long, then we should continue to be long. Actually, often it's the other case, the other way, because obviously the more people that get into one-sided position in a currency means that the more chance there is that those people leave and they rush to the exits, and then you get a decline. So people do try to sell ahead of time. So when anything is stretched to the upside position basis, you can there are some exchanges basically that offer you positioning data. Not many, obviously, because FX are traded off exchange. But there's some futures exchanges that give you a good idea anyway. The CFTC is one of them. That's the data I look at. We've seen that cut back off alongside this decline in cable. So if we see a slightly more hawkish than expected Carney tomorrow, I think expectations probably are quite neutral actually about him, because we haven't seen anyone vote for a rate hike yet. So if that happens, so where we stand now anyway is that the cable is looking, it looks like in a bit of a healthier place. And so if this 61.8% retracement holds at 167.40, that could be fairly good news as we lead up to this inflation report, and could be a good level to bounce from. 168.80 is the 100-day moving average. That's a level on the upside that I want you guys to remember, because obviously if we do get a slightly more hawkish or sterling positive news tomorrow, that's where we could head to. That would be the first level that we think would target. We may not get there, that would be kind of a 100-pip move in a day. That sounds about right in these August markets. But remember, whenever volume is low, you can sometimes get knee-jerk reactions. So again, if Carney makes a wrong step and we break below the 167.40 level, then we think, that would be a very bearish development. 166.58, the yellow line on this chart, also the 200-day moving average. Is another key level of support there. So we could be in maybe from a longer term move back down to 165 if we break through those two support levels. Now, Alan, I know you've been waiting very patiently, so I will talk to you about Aussie. Aussie has been pretty much flat, trading sideways. You're saying there's some fairly good support here. Well, it does. Well, yeah, I'm a bit agnostic about it. Looking at it purely from this level, as you can see here, yeah, we are approaching some very good support ahead of that 92 level. We are, again, there isn't too much movement going on. That can be quite normal there where there isn't, market sentiment is a little bit more balanced. We did have obviously that latest sell-off. Momentum has been crossing lower, which suggests that there could be a bit more further bearish trend to go, and which could trigger a deeper sell-off. But support is at 92.03, so that is the May low. So that is the low from this level here. Below there is kind of the 91.8 level. That is a 38.2% retracement of the whole year-to-date range. So if I just draw that in, then you can get some sense of this, Alan. And the rest of you, obviously, because I know a lot of you are very interested in Aussie. So from the January low to the July high, we then get kind of 90.84, so 91.8. So we get the first level to remember is around about that 92 level, 92.06, the May low, then 91.84. That is a 38.2% retracement of this year's entire move. So that's probably something I would watch out for. That whole level there should be very good support. I completely agree with you. That is very stiff support. Momentum does seem to be to the downside, but whether or not we extend with that triggers another deeper sell-off will depend on whether or not how we act at these levels. As I said, a move from a Fibonacci perspective, a move back to 38.2, testing it, maybe bouncing higher, isn't fatal for an uptrend or for whatever we're in the Aussie. I certainly wouldn't say it's an uptrend. It's definitely a range, which is deeply annoying. But I think that's keeping the Aussie, the RBA, very, very happy. They're really stuck in neutral mode. They're not putting their cards on the table. That compares with a lot of other central banks. For example, the ECB is very bearish. The Bank of Japan is maybe less bearish, I suppose. But the ECB being the most bearish, hence the euro falling. And then on the other hand, you have, the Bank of England maybe saying that, potentially tomorrow, saying that, igniting expectations that a rate hike is going to take place in December. I mean, all that stuff is, that's been quite transparent. The Fed also seemed to be on a slightly more hawkish path than they've been on for a very long time. And then you've got the RBA saying nothing. And that is, going to obviously, make the Aussie slightly less attractive when we're in an environment where rate differentials really matter. Alan, you're also looking at dollar CAD. Now, dollar CAD has been quite interesting because last week we saw the dollar rally, and I'll show you a chart of the dollar index as well. But we saw the dollar rally kind of fairly muted. Euro was able to get above 134, but the dollar was able to kind of extend some gains against the CAD. So the CAD's looking pretty weak. We had some pretty bad employment data as well out of Canada, and that does tend to be a bit of a trigger some movement anyway. But for example, yesterday when risk was back on, the dollar wasn't really rallying, the CAD was. But today, again, as I said, for really as long as based on nothing apart from sentiment, it seems like when stocks fall, so does dollar, so does the CAD, and when stocks rally, so does the CAD is able to kind of claw back some losses, and obviously dollar CAD heading south a little bit. So we're in a real congestion zone right now. We're kind of trading sideways, a bit of consolidation taking place. We think that there could be potential further upside, basically limited downside. Merck, yes, sorry, you say Fibonacci 3 month is important. I think it probably is. Like, you do need, you can go crazy looking at Fibonacci's on all time frames, but I really think the three, like, I think looking at it on a daily chart is just a bit more powerful. More people do it. Looking at it about 3 months, yeah, I mean, that seems like a decent move. And in those, that, basically what you're looking at retracements is trying to find when there could be support and resistance if we see a turn in the trend. So trends do tend to form over a few months. They don't necessarily form overnight. So that's why I would say kind of the slightly longer term Fibonacci's tend to be more reliable, purely because there's more people looking at them. You can always, some people will look at Fibonacci's on a very short term perspective. But in FX, it does tend to be the slightly longer term ones that are looked at more closely. They're more reliable, I suppose, that people kind of gather around. But as I said, limited downside now. We look at support at 108.47, so about 100 pips from where we are now. That would be the 38.2% retracement of the July to August recovery. And again, we would expect that to hold. Let me draw that in there. Again, more about Fibonacci. So sometimes you only need a month's data. As well. But yeah, I mean, I personally prefer it over a number of weeks rather than a number of days. So the July low there to the August high. Yeah, I mean, 108.45. That also corresponds with a cluster of SMAs or moving averages. For me, if we were to pull back to there, I think that could attract some buying interest. And then, obviously we've got the 110.28 level. That's pretty significant. And then 111.70 is the March 26th high. I'm not saying that we'll get there in one go, but if this dollar rally is for real, if the dollar has really turned a corner, then we would expect to see some further upside. Now, obviously, tomorrow we've got a bit of a risk event going on for the dollar. We've got Fed's Dudley speaking. He's a noted dove. Now, we also had Stanley Fischer, the vice chair of the Federal Reserve, speaking yesterday. He also noticed a bit too, which was kind of surprising because he's considered maybe a bit more pragmatic than Yellen. But he really concentrated on the downside risk to growth, why growth has been so low. So something to worth watching for there. Obviously, for example, if we see a hawkish Bank of England, a dovish Dudley from the Federal Reserve, then that could weigh on that could push up cable, which could weigh on the dollar, maybe on a slightly broader basis, especially in these holiday thinned markets as well. So so that's kind of worth looking at. But as you can see, it still looks quite strong. I do think, downside is probably limited to that 108.47 level. And while that holds, I think there's probably further scope for further upside to, test that main resistance at 110.28-ish. I think, Alan, what did you say? I think you may have said that you're looking at shot at 109.70. Yeah, I mean, we think that there's a potential for that to happen. Potentially, that was a high from last week again. But if we do see some further downside, I mean, right now momentum is quite difficult to pick. But I think, again, if we remain in this consolidation pattern and we were to get back down, to the lows of the day, then probably on a short-term basis, maybe retesting 109.70. On a slightly longer-term basis, though, if we do see, maybe just the dollar falter a little bit in the next 24 hours, see back down to that 108.5 level, that could also attract some buying interest, we think. Kiwi dollar, Mohammed, do you want to look at that? Yes, Kiwi is an interesting one, right? It's really interesting because it has gone through its 200-day moving average. So I'd written that down, actually. So thanks for letting me know. It went through its 200-day moving average, which came in at 84.60. And then obviously 84 is a massive level. So we're currently trading 84.24. The low of the day, let me just shorten out my time frame here. The low of the day has been 84.09. So I agree with you that 84 level is really holding, is really being tested as support now. When we covered September 2014, when will it recover? I think the market has taken quite a lot out of the Kiwi, largely because the RBNZ kind of suggested it wasn't going to hike rates anymore. So it wasn't really on a rate hiking cycle in the first place. Instead, it was just trying to negate the cuts that it made after the Christchurch earthquake in 2011. That probably throws a different spin on the Kiwi, but I think from purely technical, while the fundamentals are slightly unclear, what the RBNZ's next steps are, because they've kind of gone from being hawkish to neutral. I think on the other hand, on the other side of things, from a technical perspective, everyone's going to be looking at what goes on with this 84 level, because you quite rightly pointed out, it's massive. You know, the bearish conditions seem to be in place. We've got lower momentum indicators. And if we were to get below, say, 83.70, I think that could attract quite a lot of selling interest, and then could then maybe take us down to those February lows, or the lows of this of 2014 so far, which come in around 80.50, about 80.58 actually. Whether or not we get a recovery in September, Mohammed, I think that will be dependent on what themes arise. We know that the Kiwi doesn't do very well when there's heightened geopolitical risk, as there is right now. Geopolitical risks may have calmed down from last week, but there's still a chance of a flare-up. So that, I think, would keep people maybe on the sidelines with Kiwi, at least for the moment. So maybe September, if geopolitical concerns die down, then that could be the time to kind of, go in. Now, the one thing I want to say about CAD, though, and I suppose this is relevant now for the dollar as well, because the US is such a big oil producer. There is nearly a full-scale civil war in Iraq. There's also, a lot going on with Russia and Europe's energy needs, and yet we haven't really seen any type of increase in the oil price. I'm just going to take a look at Brent, purely because we're in European hours. US isn't really in yet. And as you can see there, another decline today. I mean, it seems kind of crazy to a lot of people. I'm just going to go back a little bit further. I mean, we're getting towards that 100 level. Is obviously, in Brent is obviously kind of significant, but it does seem a bit of an anomaly that we have all this kind of geopolitical risk, and yet the oil price actually fell. So some people sit there and think, well, the oil price should rise. I think in this environment, when the oil price isn't doing as one would expect during a geopolitical turmoil, it could potentially mean a couple of things. Number one, that growth isn't necessarily as strong as some expect, that the market is getting very worried about tighter monetary policy. And that's being priced into oil right now. Maybe it's the potential Fed tightening that's trumping any geopolitical concerns. If we look at WTI, it's moved in a very similar direction. They do tend to move in the same directions, guys, as I'm sure you know. Easily below 100, testing the lowest level since back to the start of the year here. If we fall through this low, let me just grab it for you. If you fall through the most recent low, which came in around 96.50, or just below 96.50, 96.40, so about 80 pips from where we are today, then we could potentially opens our way back to that lowest level in 12 months, which is also the low of the year so far, which comes in at 105. Oh, sorry, no, it doesn't. Let me just let's try and get this back together. Sorry, that comes the low of the year so far is 91.24. So is it pound on fire? Is it seasonal or it's stocks? Well, obviously it is summer months, so there is reduced demand. There tends to be reduced demand, one should say, for oil, but then you get the summer driving season in the US. We have seen probably a pickup. If I just show you just a table here of events, that commodity releases every week, we get the US with their inventory data. And so we have seen, inventories have actually been falling. So let me just do a chart of that so you can see it. Inventories have been, I suppose, they have been falling, so that one would assume should put up pressure on the price, but it hasn't. So it's a little bit worrying. I think it's possibly, I think stocks have been falling on geopolitical risk, and usually in that time commodities rise. So it's a bit strange that stocks and commodities have been falling together. If anything, it could be real concern about the growth outlook. And I think if that's the case, then do watch out, because, if anything, commodities seem to be moving more in line with treasury yields. And if I just show you treasury yields here, treasury yields are incredibly low. Yes, they picked up yesterday, but they are still at their lowest level for quite some time. Still at their lowest level, really, since mid 2013, so over a year, 14-month low in the US Treasury yield. And that seems to be more reflective of an uncertain growth environment, because in fairness, yields have been falling, and then the fall was just accelerated during the geopolitical risk. But it's funny that commodities are following suit. It suggests that maybe the bond market and the commodity market don't necessarily believe in the growth rebound, and then that could feed through to stock markets later down the line. So that tends to be how that relationship works, with kind of the bond market being the king of the financial market universe, That then feeds into what commodities are doing, which then feeds into stocks. Obviously, in some ways, lower commodities are good news for stocks, good news for corporates as it reduces their cost base. However, if it suggests something bad for the economy, then that's not good. So that's just the relationship. Anyone who reads John Murphy's books should know about that. The other thing I was going to mention, obviously, is stocks. So let's look at the DAX, because on Friday, obviously, the DAX has been under a lot of pressure. It's the German stock index. It dropped below 9,000 at one point, did close above it, and managed to recover from there. 9,000 is a massive level. A lot of people think about it. It'd been the good support in March as well, even though we did dip below it only for a temporary period, and obviously it held in December. So it was no surprise that the market hesitated at this level. But again, the recovery that we saw yesterday has been particularly weak. So indeed, getting lulled into sleep by these market moves, yes. But I would just, this is a good time to do your homework and to John Murphy is a composer. I'm assuming a composer of maybe of market strategies. For sure, he's a successful guy. Sorry, just going back to the DAX quickly, as you can see, we've got 9,000 held as very good support. That's the first thing to note. However, the recovery yesterday was pretty weak, and it's not being followed through today. When that happens, it's always worth watching, because there could be further downside to come, especially as we lead up to that GDP report from the Germany, which is 7 o'clock on Thursday morning. Now, I'd like to leave you with a few thoughts, really, because I kind of think that looking at the markets overall, I think that certainly the euro could come under some pressure as we see Germany deteriorate. That 132.50 level, worth watching very, very closely. We think the pound could be in for a recovery, and that's that will largely depend on what happens in the inflation report. If that happens, then we could see euro sterling come under even more pressure. We could also see the dollar take a bit of a beating, which is kind of worth watching out for. But the DAX as well. I'm just a bit concerned about stocks, a bit concerned about commodities. I keep expecting oil to rise again, and it doesn't. And so I'm just kind of sitting on the sidelines watching that one out. I do think it's slightly odd, though. Okay, guys, I'm going to leave it there because it's the end of my time is up. But I will hopefully you'll be able to join me next week, and we can talk more there. So thank you, everybody. I know some of you join fairly regularly. I will hopefully see you all tomorrow. So next week, not tomorrow. So thanks again for sharing.